Good afternoon and welcome. Today's discussion features Peter Torrente, KPMG's National Sector Leader for Banking and Capital Markets, and our guest, Michaud, President and CEO of KBW. KBW, an investment bank focused on the financial services sector, is a subsidiary of Stifel Financial. KBW's highly regarded bank research team has the broadest coverage of the banking industry on Wall Street, covering not only the nation's largest banks, but most of the leading regional banks as well. And now for our presentation.
Tom, welcome and Happy New Year. Hope you're doing well. Thanks for joining us again. Certainly a lot has transpired since we were last together in October. And with fourth quarter earnings kicking off tomorrow, I think everyone would appreciate your views on what do you see as the drivers for the fourth quarter?
Well, Happy New Year, Peter. Great to be with you again. And yes, we are on the verge of another bank earnings reporting season. And as is usually the case, the banking industry is usually one of the early reporters in corporate America. Tomorrow, we think that when earnings kick off, there are going to be a couple of key themes that look very familiar to the market. One is we are in a period of very strong net interest income growth. We actually think for the spread lenders and the traditional banks, net interest income year over year could have 30% growth, which is about as strong as I've ever seen it. And that's because we've been getting loan growth as well as margin expansion because of Fed policy. So that's going to be a big driver. And so the banks that are very focused just on traditional lending, we think on a year over year basis, they're going to do quite well. The banks that have big non-interest income components, however, may see a few more headwinds. There are two businesses that really feel to us like they're already in recession. One is mortgage banking, where activity and originations have really dropped considerably. And the other is investment banking. Investment banking feels like it's in a recession. We're in the 13th month of equity markets essentially being closed in terms of new issuance. And the higher rates have led to less debt issuance as well as there's been a decline in trading activity. So we're looking for a 60% drop year over year in broad investment banking revenues for the banks who are big in those businesses. So when you add it all up, we're looking for the industry to earn 12% more than it did last year on an earnings per share basis, which is pretty good. However, we believe that this net interest income story is at a peak. For example, we're looking for 8 basis points of net interest margin improvement. That was a high 20 basis point figure in the third quarter on a linked quarter basis. And by the end of next year, we believe that we'll be looking at margin declines if Fed policy plays out as we expect. So we think that the fourth quarter is going to be a very good quarter from a revenue perspective. There'll be certain segments that'll have headwinds. The actual reported numbers we think will be pretty good. We're also expecting for credit quality to continue to be pristine. But we also, on the negative side, we should talk more about that, is funding. The market's going to be very focused on what's happening to deposit costs, what's happening to deposit levels, and what's happening to deposit betas, and how aggressive is the industry having to be for pricing competition on deposits.
Tom, you touched on deposits there at the end. Maybe talk a little bit more. What do you see as the big dynamics around funding and deposits?
So really, this may be, when you think of what are the stories of the quarter, I think this is going to be one of the stories of the quarter. I really believe that in the third quarter of last year, you had a period of time where deposit competition really heated up. So for the early parts of this rate increasing cycle on the part of the Fed, the banks were really able to lag their deposit costs and use a lot of the excess liquidity on the balance sheet. The banks had built record amounts of excess liquidity in the balance sheets during the pandemic. But what you're going to find is by the end of the fourth quarter, we believe that all of that excess liquidity relative to traditional levels has been used. So the banks are no longer able to fund loans just by selling bonds. They actually have to go out in the market now and find deposits. And you could see that dynamic really kicking into the market. Also, investors and consumers and depositors were not that particular about what deposit rate they were receiving when rates were near zero. But now that rates are at a much higher level, you're seeing the banking industry compete much more for these deposits. So what that means is the marginal benefit of higher rates is not going to be falling to the bottom line as this competition heats up. So we think that the deposit betas for interest-bearing deposits is really starting to cook. And that's why we believe that the fourth quarter is probably the peak moment for growth in net interest income. And as 2023 plays out, you're going to see declines in the growth rate of revenues and net interest income growth for the banking industry.
Tom, you touched on credit a little bit. I think you said pristine. Just given the economic outlook and credit certainly on everyone's mind on how that may play out. How do you see that provisioning for the quarter and maybe how credit plays out over the next couple of quarters?
So we're looking at an increasing level of provisions for the industry, and we're also looking for an increasing number of banks to take a more conservative outlook about 2023 and the future with regards to their provisioning. While we don't have supersized provisions in the quarter, we do have higher provisions in the quarter. We wouldn't be surprised if banks started to take more precautionary provisions for loan losses in the fourth quarter. And the way that technically happens is that the baseline outlook changes, which allows for the accounting policy within CECL to allow banks to be able to put more money into their reserves. And we wouldn't be surprised to see if management teams started to take a more conservative approach. So if you were to list the reasons why we think we might be wrong in our earnings per share estimates, banks taking more conservative provisions would be a likely topic for why that might happen. So basically, if you think for 2022, provisions were about 14 basis points of loans. We think that's going to be more like 28 or 29 basis points of loans in 2023. And I would believe that if that number is not right, provisions could be even higher than that. And I think that's one reason why bank stocks have been trading where they've been trading, is that investors are concerned that if the economy slows too much, we could be entering into a harsher credit cycle.
Tom, maybe turning outside the regulated banking industry, talked about credit and you talked about valuations as well, but maybe what are you seeing outside the regulated industry and the shadow industry, if you will?
So the shadow banking industry is been something that we've been talking about really for over a year now in particular, because zero interest rates were the rocket fuel for the shadow banking industry. And so its growth has been remarkable. Now that interest rates aren't zero anymore and this whole deposit competition continues to keep growing by the day, it's going to put pressure on financial institutions that aren't banks to fund themselves. Not only that, but there have been some accidents, as you know, in the shadow banking industry, especially in the crypto sector. And there's been some really harsh performance with a couple of companies recently filing for bankruptcy. So what we think that the impact of that is that's going to make it more costly for non-bank banks to fund themselves. So that's something that we're going to be paying close attention to. The other item is the banking industry, we think, has taken a very conservative approach to credit in general. Whereas I think the willingness to take on a little bit more risk has been happening outside of the banking industry in the shadow banking industry. So market participants are going to be looking very closely for any signs of credit quality issues in the shadow banking industry and in the non-bank lenders, whether that's in leveraged loans, could be in subprime lending, could be in auto lending. Those are popular topics that come up for what's, I think, going to be very closely followed in the fourth quarter, especially for non-banks.
Yeah, maybe continuing on sort of non-bank, non-traditional. On previous quarterly calls, Tom, we've talked about the fintech industry. Obviously, we've got a higher rate environment, but just your view on the fintech space.
Sure. Well, one thing that is really interesting is that during COVID, the degree of digital engagement in financial institutions was very high. The engagement was accelerating. And that energy, while it may have ebbed a little bit by the client base of financial institutions as COVID is more in the rearview mirror, the energy around building digital expertise inside the industry has not changed by management teams, for example. So we are continuing to see banks announce JVs with fintechs. We've seen acquisitions of fintechs by banks, and we've seen some fintechs become banks. But the dynamic that's changed is the valuation of the stocks have really, really reversed themselves in terms of the premium that fintechs used to enjoy relative to banks. This whole risk-off trade for growth companies has really changed the financing dynamic, such that a lot of fintechs that were able to very easily finance themselves or raise capital, that market's gotten harder. And I think as that market's gotten harder, it could lead to more strategic tie-ups with banks and more traditional financial institutions. I'd also say that I believe that you're going to see more regulation in the shadow banking space. And this is regulation that's already inside the banking industry. So I think that that development in terms of share prices, cost of capital, cost of funding, regulation now, it's going to continue to level the playing field a little bit more from where it was in prior periods. And I think from a competitive aspect, it's going to come the bank's way a little bit more.
Maybe turning to M&A, I know in prior calls we've talked about M&A, and it was a lot around your views on when deals would get approved. We're obviously in a different market now, but just maybe your outlook, Tom, on the M&A environment and when that may come back.
Sure. The industry's been consolidating since the early 1980s, so it will continue to keep consolidating. That shouldn't surprise anybody. It's been quieter for the bigger banks since the big announcements of 2021. But that's not unusual when we have a pivot occurring in the economy and with the big volatility in the stock market that we've had. So once you get more orderliness, in my opinion, you will see M&A return. But you mentioned it about the approval periods. There have been a couple of dynamics that have changed as the public policy out of the White House has changed towards heightening the scrutiny of mergers in general, not even just bank mergers. I think that is a cost that's going to need to start flowing its way through M&A. And we've had a couple of banking deals go more than a year before getting approval. They've gotten approved, which is good, but it's taken probably twice as long. And I think going forward, there's going to have to be a recalibration for banks that think that they may be in this longer approval process in terms of how they factor that into their models. So I think we're in a little bit of an adjustment phase, but I do think that we will return to a more active phase of M&A because if you look, scale has been working. Bigger banks have been more profitable. Bigger banks have been trading at higher valuations. And so there are a lot of drivers, I think, that are in favor of it.
You touched a little bit on regulation, Tom. Since we last talked, we had the election in November, and now we've got divided Congress. Maybe any views on how that situation will impact the industry over time here?
Yeah, I think that the market is clamoring to see what the crypto regulation and legislation is going to look like. And both sides of the aisle are talking about it. The regulators are talking about it. The White House had been talking about it. I think we just needed to get to the new Congress to be able to start working on it. So my instincts are the regulatory perimeter around financial activities is about to expand. And I think it's going to include more companies. It's still yet to be seen which regulator will emerge for which type of company. I think that it will continue to be debated. But my opinion is you're probably likely to see something around the crypto space in this new Congress. But of course, with a divided government, you're probably not likely to get tremendous meaningful legislation. With regards to regulation, typically an administration in the second half of a term gets a chance to be more impactful for getting their policies into the market. So, for example, like what we recently or earlier talked about with the merger policy, for example, that's now getting ready to be implemented. And so I think you're going to see more of the policy directives out of the regulatory agencies now that they've got more regulators in the permanent positions, and they're able to work through the process of getting new rules and regulations out. And that's probably not just for banks and financials. That's probably corporate and industry wide.
Maybe one last question. You talked a lot about the fourth quarter, shared some of the views, maybe looking out a little bit, but any interest in sharing just a kind of full recap of maybe what you're looking at for the rest of 2023, and then to the extent we do have a short and shallow recession, maybe any views even looking out into 24 and how things may come back?
Sure. So I would describe our research department's approach as one of a soft landing, which is that we see GDP growth slowing, but I think most importantly, we see the Fed funds terminal rate peaking sometime by the end of the first quarter, or at least in the first half of next year. If we continue to get inflation readings that shows that the Fed's actions are working, and that inflation is beginning to slow, I think you'll start to see things open up a little bit more. That will help. But the other key thing we're watching as well, of course, is unemployment, as to what that will mean ultimately if we're right in the hard or the soft landing. So we've been in the soft landing camp, and what that means for financials is once the market gets more comfortable that inflation's under control, we think that the capital markets and investment banking businesses will open up. And so that's why when you look at our ratings, we like companies like Morgan Stanley and Goldman Sachs, for example, who are big investment banks, because we think they'll move out of that recession moment and get into a better and more robust environment. So that's number one. If we're right in our soft landing approach, capital markets, I believe, are bound by the end of the year to reopen, and you'll see investment banking activity pick up. So that's number one. Number two is as the Fed hits peak terminal rates for this cycle, it's going to mean that the deposit competition will remain high, but the banks won't get any relief in terms of rates on the asset side. And you're going to see net interest income growth really stop as we go into 2024. And what we think is likely to happen is that you'll get that slowdown in revenues at the exact same time that provisions are going up, plus inflation costs continue to kick in for financials. So for the core banking sector, we think you're likely to have no earnings per share growth going into 2024 from 2023. So when you look at the stocks, which we spend a considerable considerable amount of time focusing on the stocks. We think that investors are now trying to calculate, how does it feel if we get into a 2024 situation with no earnings per share growth and a little bit still of uncertainty about where the provisions may go, because that is one of the wild cards. I think, if we get a little bit more good news on the economy, or if we do get good news in the economy with regards to provisions, that could be a very bullish moment for bank stocks, even with the limited earnings growth into 2024. So that's kind of how we feel about it, which is right now the banking industry is enjoying good results in the core business. Investment banking, we think, is about to pick up. Provisions are the wild card. But all this growth has been pulled forward and will lead, we think, to very limited earnings per share growth into 2024.
Great insights, Tom. As usual, thank you so much for sharing not only your view on the upcoming quarterly earnings over the next couple of weeks, but also your willingness to look further out into the future. Always appreciate the discussion and look forward to do it again in the first quarter.
Terrific. Great, Peter. Great to be with you, and thank you for having me.
Thanks, Tom.